How many people were here yesterday for our last session, 10 Reasons Why the Sharing Economy is Bollocks? Yeah, that was a great session. Well, Milo said that the sharing economy is bollocks because the wealth generated isn't shared and that the same people get rich. Interesting perspective, particularly when you think that in addition to tangible assets, which we've been talking about so far, things like cars, tools, etc., what about capital itself? Not only perhaps can we share our items that we have for a return, but what about the money that we have in our bank account itself? Next up, we have a panel on money and the sharing economy, and it's going to be moderated by CNN World Business Today anchor Nina Dos Santos. Please welcome her and the rest of the panel.
Thank you very much for having me today. I'm Nina Dos Santos, as you just heard there, the anchor of CNN's twice-daily business show, World Business Today. Many of you out there in the audience are technology entrepreneurs yourselves. Some of you work in the venture capital business, helping to fund some of these startups. And funding is a big issue, isn't it, for technology startups the world over. It's also a landscape that's changed enormously, and that's largely also due to the advent of crowdfunding. I'm delighted to say that today we have three protagonists of that type of change. We are joined today by, on my left here, Samir Desai. He's a regular at LeWeb. Some of you who are here this time last year will remember that I hosted a panel with you, Samir. Samir is obviously the co-founder of the Funding Circle and CEO of that, which is a UK-based institution which helps people invest in individuals and also businesses, and that's where you're different from the others. We also have here in the middle Raffael, who's the co-founder of auxmoney.com. Again, the difference is that you're investing largely in individuals and crowdfunding for that. And then, of course, last but not least, Renaud Laplanche. Many of you know this man. Literally, your company is the biggest in this industry, based in San Francisco. Renaud is the CEO of the Lending Club. Just before we get going, a thought for you. This year, industry statistics reckon that about $5.1 billion is likely to be raised for companies and individuals via crowdsourced funding. And given the fact that we're here to talk about the shared economy, that is now starting to happen in the financial space. The figures I've just cited are twice as big as the ones for last year, and that continues a trend. So, first of all, Samir, we were here this time last year. I just asked you how big your business is, and you said that figures have trebled.
Yeah, so the business has trebled since we were here this time last year, so we're now lending about £10 million a month. We've lent in total around £109 million since we launched 2.5 years ago. So we're really starting to see an acceleration.
And you're the newcomer here, Raffael. So tell us about your company, because for those who aren't particularly familiar with it, you're specifically in Germany. What kind of market is that?
What we do is we facilitate lending between individuals. So different than Samir, who facilitates lending to companies, we do peer-to-peer lending in the way that we bring borrowers, private people, and investors together. So what we do is we facilitate loans between 1,000 and 20,000 euros. And what we started with last year as the first P2P lending company in the world basically is also facilitating secured lending, so the borrower has an opportunity to pledge his car as an additional security.
Now that's interesting, isn't it? The collateral here is changing as well. And that's part of the shared economy as well, isn't it? People putting up all sorts of different things as collateral, whereas maybe 5 years ago, your car, never.
Yeah, that's true. I think it's a big market. I mean, if you just look at Germany, the unsecured market is roughly 200 billion euros. And if you also take car financing, just car finance, leaving out mortgages, that's just an additional 200 million. So it's a very interesting market, and the same dynamics, you know, taking out the bank as the classic intermediary applies there to offer better economics for both the lenders and the private borrowers.
Now, Renaud, your business model is more similar to Raffael's here. But I just want to point out for the audience, you're the other person I asked, how big is your business now? And both of you have said that it's trebled. But it's come from a low base, though. Isn't there a natural sort of capacitation in the crowdfunding market? It can't get as big as the biggest investment banks, can it?
Mm-hmm. Yeah, no, talking about market size, I mean, the US consumer credit market is a $15 trillion market. So this year we're going to facilitate $2 billion in loans, which is also almost 3 times what we did last year. So the company is growing very fast, but it's still only $2 billion on a $15 trillion market. So we have some runway in front of us.
What about new products in this space? Because, as we were just saying before, you two gentlemen are more about lending to individuals. But are you going to diversify that model, Renaud, especially considering as you're the biggest?
Say that again?
Are you going to diversify that model to offer new products?
So the main use case for the product is really for consumer to pay off existing balance on their credit card. The credit card balances in the US carry interest generally between 16 and 18% interest rate. So it's a very high interest rate, and we offer a more responsible and lower cost way to pay off these balances with a installment loan that amortizes each month. So it's also a more responsible way and more predictable way for consumers to manage their credit.
Raffael, obviously the big question here is if people out there are crowdfunding other people's credit card debts, investing in other people's debts, they're hoping to get paid back. Mm-hmm. And how can you guarantee that the platform that you offer means that they will eventually get paid back and they know whose credit card debt they're investing in?
Yeah, we don't guarantee it, first of all. But if you now look back 5 years of company history, we have a very good track record of forecasting what the kind of returns will be. So the average interest rate that we see in Germany on our platform, on Aux Money, is around 10%. And after you deduct fees and defaults, the investors end up with a return of between 6 and 7%. So in case there is a default, the lender has to do nothing. We as a platform, we're the company, we go after the borrower and make sure that we receive the money anyway.
Samir, what's the difference in investing between individuals and companies? Because you're on a slightly different tack here. Investing in companies, not all of them necessarily work and survive.
So we lend to established businesses, so businesses that have been trading for at least 2 years, so not to startups. And it's a similar type of thing. So we have rigorous credit assessment processes. We have underwriters or credit assessors that work at banks that look at every loan application, and people spread their money across lots of different businesses. So the net returns are actually pretty similar to what you get on Raffael's platform, so between 6 and 8% a year. I suppose some of the differences that we've seen is because business lending is quite a political issue. We've actually now seen the UK government start lending directly through Funding Circle, which is the first time public money, we think, has been lent over the internet directly to businesses. And it's all part of actually kind of stimulating the economy, stimulating demand.
Well, that was what I was coming to here.
Yeah.
How big is a company like yours going to get if it's starting to play a completely different role?
Yeah, so I mean, I was going to disagree with your original point. I didn't get a chance to that. I think this will be a huge part of the market. Independent surveys that were done recently on Funding Circle suggested it could be 10 to 20% of the market. And one of the reasons I believe this is, if a survey that was done on Funding Circle business borrowers found that 77% of those borrowers that had borrowed through us would always come to us first rather than go to the bank for a loan.
Okay, so why did they do that? It's because they can't get a loan at the bank?
No. It's because it's faster, it's quicker, it's internet-based. If you want to get a business loan, you still have to go into a bank branch, sit there with a branch manager. And a lot of the people in this room are business owners. You're busy. You don't have the time to go into, take time out of your day. Half of our loan applications actually come outside of business hours. So what we say is, this kind of loan product better meets the needs of businesses. It's not just an alternative to banks. It's actually a fundamentally better product.
But you won't be lending the same amounts as banks, or will you eventually?
Yeah, I mean, we started off doing loans up to £50,000. We now do loans up to £1 million. Eventually.
How big could that get?
Sorry?
How big could that get then?
Well, I don't see any. So far, I've seen no real limit. We're getting the same kind of acceptance rates. I think it could be huge.
Just if I might chip in on the same topic, it's really interesting. It's been really a transformation in the way the industry is perceived over the last 5 years. I think there was a risk that we'd get adversely selected against the banks and that the best customers would go to the bank, and if they couldn't get a loan, they would come to us. We've really managed, I think, as an industry to flip that around, and through a better customer experience, through really caring about the customer and operating at a lower cost in a more convenient way and passing on savings to the customers, we've managed to generate positive selections with the best customers coming to us. And actually, in our case, we are selling some of our declined applications to banks.
Raffael, would you say that in Germany, there's room for this, because it's notoriously difficult to get access to debt, you know, it's bureaucratic?
Yeah, definitely. In Germany, the same dynamics that these two gentlemen just pointed out apply as well. And in addition, I think there's a great market also for entrepreneurs, like startup people in a private capacity to get a loan on platform like this. So because banks don't touch them, right? Because they are high risk, they don't have a regular income. But I think if you do the risk management right and are able to separate the right from the others, then it works with those as well. So I think there's certainly the big market is also to offer an alternative to the banks, but there's also a market where banks, which come under increasing regulation, where it becomes more and more expensive for the banks to hand out those loans, where they go away from, I think there's a new niche that is created, which P2P platforms will benefit from.
That's what I was going to come to next, regulation. So on the other end of the spectrum, the private equity industry in Germany has had a really rough time with legislators asking for more regulation on that front, ditto for VC, etc., wherever you look. I suppose some politicians might be viewing your industry and saying, well, it eventually will get big enough to regulate. What's your response, gentlemen? Starting out with you, Raffael.
Yes, I think regulation is you can look at it from both ways. On the one hand, asking for regulation for our industry might be a good thing in the way that that it gives you a stamp of approval, which particularly for lenders would help in that regard. And the financial industry per se is a heavily regulated industry in Germany, and although we are not regulated, we operate in that framework where we comply with lots of the demands that would apply also if we were regulated itself. So I think it would be a good thing, and we are asking for in Germany also to see government support, because there's a credit crunch as well, and we are giving also the government a tool for providing capital to private people or to companies.
And that's never more true than in the UK as well, where you were just making the point, Samir, companies, small to medium-sized businesses just can't get access to the money they need.
Yeah, and you know, on the so with Funding Circle, we have central government lending through us. We have local councils, so effectively regional government lending. So there's all that. On the regulation point, I don't know if you remember, but this time last year, you know, I said, well, we've actually been lobbying for regulation. So
you've written white papers on the subject too.
Yeah, and actually, the good news is that we succeeded, and we are getting regulated from next year. So the FCA will become a regulator, and I think that is quite important because, you know, first of all, every article that gets written about Funding Circle at the moment ends with, but they're not regulated. So I'm sure like half the people switch off as soon as they see that. And it just gives credibility. It lets people know that actually, okay, this is a serious thing, and it is here to stay as well.
Renaud, obviously, you've got the US perspective on this, and the United States is not a place that likes regulation any more than the UK. Would you agree with what Samir has said, that you need credibility, or if you look at your company, you're big enough already?
Yeah, so in our case, we've fell pretty squarely within existing regulatory framework. So there wasn't a need for additional regulation specific to our activity. So we were regulated by the SEC on the investor side, and we feel within a banking framework. But I think more importantly, as a matter of public policy, we worked very hard to be the good guys of financial services, and the regulators are really perceiving us that way, and realizing that we make credit more affordable for US families, and we do so in a way that's very responsible, that's very transparent, and that gives, that really provide great customer satisfaction. So we do all the things that the regulators would like the banks to do.
So what's your average default on some of your loans?
So we have a grading system. So we start with a very tight credit policy, and then within our approval band, then we grade loans from A through G. So investors can choose the level of return they shoot for and the level of risk they're willing to take. On average, on a 3-year loan, we record about 3% annual credit loss. And that leaves 8 to 9% net return to investors after credit losses.
What about you, Raffael?
It's very similar. The returns are slightly lower in a range of 6 to 7%, and defaults rate between 3 to 4% across the whole spectrum of loans.
And it's, Samir, out of the company perspective, does the default rate change? Is it still low single digits?
So our default rate is about 1.5%.
So lower for companies?
A bit lower, yeah, and our rates are lower. So we're typically between 6 and 8% net returns as well.
Now, I just want to make sure that the audience knows that they can tweet me with questions. Unlike some of you out there, I've left my smartphone behind, so I've got the BlackBerry, but I do get access to your Twitter questions. You can tweet me at @SantosCNN if you'd like to ask questions. Let's look at this from a slightly different perspective, gentlemen, if I may. People out there in the audience, a number of them will be thinking about starting up their own company. What kind of advice would you have for them? Because you three have picked a particularly complicated sector. Renaud.
Advice for starting a company.
A technology startup, particularly in the financial side of things. Is there room for more players in the space? We have a new player on the city this time.
So I think in the US, it's the absolute best time to start a company in financial services. I think the banks have gone through the 2008 credit crisis with great difficulty. They're trying to rebuild their business now. But they're really sort of hampered by sort of additional regulation, additional scrutiny, by the fact that they let go a lot of good people in 2008 and 2009, that these people are no longer available necessarily, so they have to rebuild their staff before they can rebuild their business. I think they're having a hard time doing so. So there's a lot of unmet market need in the US right now in financial services, and we've seen many payment companies coming out, a lot of activity in our space as well. So I think it's a great time to get started.
You're talking about the United States, which is the world's largest market, world's largest economy. Now the world's second largest economy is China, and it has a huge dearth of financing opportunities. In fact, we've got a huge shadow banking industry that's crept up, doing more or less what you do, but in a very unregulated basis. Would you say that that is where some of the growth could come from?
I think obviously everyone talks about growth in China, and China is growing very fast, but I would echo Renaud's point actually. I think if you look at, I think we're in a generational shift in financial services. So prior to 2008, 2007, 2008, the internet hadn't really disrupted financial services that much. So you had, aggregated sites, stuff on the edges, but no one had really come and taken the core business of banks, savings and loans, money payments, things like that, and disrupted it. And what you had in 2007, 2008 is a real shift in, I think, public trust and satisfaction with banks, and also, the willingness of people to try new things. So what you're seeing now is the core business of banks, through platforms like ours, disrupting the savings loans, things like TransferWise, disrupting money payments, equity as well. I would say this is the first time the internet has really come to financial services, and financial services is the biggest market in the world. So it's not all about China; it's about developed markets as well, really.
Raffael, was that the catalyst? What was the catalyst in Germany, from your experience? Because 2008, the internet was well up and running. 2008, Google was not quite as big as it was today, but it's still huge. What changed?
I think it was just the idea that happened at the time, where we thought about, and I come out of the financial industry before founding Aux Money, that we thought there must be a better way to allocate capital. Yeah? I mean, banks have been set up for that purpose to allocate capital and distribute it onto people, to businesses. And we thought, okay, with the internet, so with my co-founders, we got the thinking process going. How can we be more efficient and get the money basically from the source to the recipient straight away? But it wasn't something that was driven that we said, we had that idea for long and now we feel that the time is right. It was just something where at the time we came up with the idea and just went for this.
That's actually a great point. I think innovation very often comes from people coming from outside a given industry. I think in my case, I had the idea of Lending Club when I realized that I would be paying 16% interest rate on my credit card balance. I thought it was nuts. But most people in that industry find it that it's the current interest rate and there's nothing to do about it.
And in fact, a huge part of your business is people in the United States refinancing their credit card debt via crowdfunding. When you started that out, Renaud, what were you thinking? Were you thinking this is a bit of a gamble? People might not necessarily trust investing in other people's credit card debt. Be honest, did you think that there was a risk?
Yeah, no, there was great uncertainty as to whether we'd get market adoption and how long it would take to get that adoption. I think we had a pretty slow build-up in the first 2 to 3 years. We also happened to start in June 2007 and very quickly got into 2008, which wasn't a great time to invest in consumer credit. But I think now with 6 years of track record, we're actually at the point where investors we've earned the confidence of the investor community, and we're getting large investors now, including corporate pension plans and insurance companies to invest on the platform.
Now, I've been getting some interesting comments from the audience here, and one of them is something that I was going to address next, particularly with you, Samir. Ali Klaban has been asking out there, thanks for your question, do investors know which companies they invest in, and if so, do they then have an opportunity to help them succeed? This is obviously one that you should take, Samir.
Yeah, so the way our platform works and the way these guys' platform works is a marketplace. So you can actually go on, look at the individual companies, you can ask them a question, you can pick and choose the ones that you want to lend to. You can do it through an automatic way as well, and about half our investors do that, but half of them actually like to pick and choose the companies. And yeah, you can have a relationship with these companies. I mean, you know, we've got Chinese restaurants, furniture makers, jeans companies, and all of, and in some cases they offer special deals to people that lend to them. So you do get that kind of direct satisfaction. And what we also find is a lot of lenders you know, like to lend in their local area, so they like to lend to businesses around their region.
Be honest, do you really speak to the heads of these companies that you invest in, or is that sort of, I thought that was the benefit, the anonymity, if you like, as well, of crowdfunding?
No, I would say the opposite, actually. I don't think it's about anonymity. I think it's about transparency. So it's about, you know, if you go to the Funding Circle website, you can download a spreadsheet, you know, just like you can with these guys, with every loan that's ever been originated. You can see the data on defaults. So it's taking something that's very hidden in banks and making it completely transparent. And I think the companies like that as well. I mean, you know, we used to think in the early days, oh God, these guys hate getting asked questions and all this kind of stuff. And actually they love it because, you know, they're business owners. They think, oh my God, like someone cares about my business. They're really interested. And
that's quite interesting.
Yeah, maybe just to add to that point and also to your question as a piece of advice, I think while you're little, to do things that are not scalable once you reach a critical size, and really like talking to investors and to borrowers each time at the beginning is something that turned out to be particularly helpful. Also really learning about the user experience and what they're really looking out for. And obviously once you scale, that is a very valuable insight.
And if I might add, Samir's point of transparency is really key, because if you look back at the financial crisis, I mean, these companies are really developing an alternative financial system that's fundamentally safer and sounder than what existed before. And a lot of the way we arrive there is by providing more transparency, in sharp contrast with the opacity of the credit default swaps and all the instruments that were created pre-2008.
But will it be safer? If it's a world where people like you will be bigger, it'll be more fragmented. Will it be safer, do you think, Renaud?
So there's one thing that makes it fundamentally safer compared to the banking system is the perfect asset liability matching. So the banking system consists for the banks of taking deposits and leveraging these deposits 1 to 8. And essentially lending 8 times more money than they got at the bank. And that's what creates instability in the system. All of our companies have perfect asset liability matching. It's 1 to 1. There's no leverage in the system. It's fundamentally less risky.
That's an excellent point, and it brings me to the question that if yours is a natural balance because it's a platform marketplace, can the world's financial institutions learn from that, Raffael?
I think there are a few things that we do differently. The way, I mean, we are built on technology from the ground up. And I think banks come from a different standpoint where there have been branches, first of all, and that's still, it's very difficult for them to go away from that process. So we are built on technology, and that facilitates, or that helps us being slimmer and you know, reducing the cost so that our marketplace participants, both the borrowers and the lenders, investors, benefit from it financially.
Now, I've been asked a brilliant question by a certain M.K. Lemos out there in the audience, and I'm going to direct it towards you, Renaud, because obviously you're French, although you're the representative from the United States here. The Bitcoin, virtual currencies. I suppose that's, if anything, the biggest indictment of our financial system, that people are trading in virtual currencies because they don't trust our own. What's your take on the Bitcoin?
So I think we're very much in the infancy of virtual currencies, and Bitcoin is at the beginning. I think there are a couple of things that need to happen for Bitcoin to really become a currency that mainstream America or everybody around the world can really trust. I mean, the very first thing that needs to happen is more stability. You can't have a currency that has 20 or 30% volatility with monthly volatility and people trusting it. So that needs to be, I think as there's going to be more liquidity, prices will start to stabilize and there will be a little bit less volatility.
So you're not a buyer of the Bitcoin?
Not at this point, no. Not yet.
Not even a lender in the Bitcoin world. Let me come to you, Samir. One of the big ironies here is that obviously you're a company that's lending to small businesses, 50,000, maybe up to $1 million, but you're backed by venture capital, bona fide VC companies yourself.
Yeah, I mean, it's a different kind. We lend to different types of companies. So we're lending to the kind of, you know, mainstream. In the US, you call it Main Street. So, you know, restaurants, manufacturing firms, things like that. Whereas, I think what Funding Circle is, and you know, what I'm sure a lot of the people in this room are, is we're a kind of, you know, get big quick type of company, and you know, we still lose money. We need a lot of money to get to the kinds of scale, you know, to get to Renaud's kind of scale. You need a lot of money, and
doesn't buy you first from the sounds of things.
And unfortunately, you know, just like a lot of businesses struggle to get bank loans, I don't think a bank would lend us the money to try and expand either. So, you know, venture capital, and look, we have very supportive, very good venture capital investors, and they've been very good for us as well. So.
But do you think that for people out there, if there's anybody out there who wants to start a company like yours, or the size of yours, that they'd be able to do so one day through crowdfunding?
You know, I think equity crowdfunding is a very nascent market at the moment, and it'll be interesting to see how it develops. I think in the same way that peer-to-peer lending has grown very fast, I'm sure there'll be a market there. I mean, ultimately, you know, if you're deciding between venture capital or traditional routes, you've got to kind of decide whether you're a get big quick company or whether you're a kind of organic growth company, and the strategies are very different in those. You know, in get big quick, you're spending money quickly to try and grab share. In organic growth, you want to keep everything as lean as possible, really.
Raffael, are you a get big quick company? And somebody from the audience has asked me, if so, do you sometimes have to use unethical practices to get money back from borrowers?
Look, first of all, I think in this particular industry, you, at the beginning, have to overcome, we talked about regulation, we all have to act within the regulatory framework, and there's a second element, which is risk management. So the better we do that, the better the experience for our borrowers and lenders at the same time. So it takes time to build these two very important pillars for the business. And only once you have them in place, you can really start scaling the business. And to your second question, no, we don't do that. I mean, we talked about transparency and trust, which is absolutely the key element for us as a platform. And so Aux Money doesn't do anything in that regard.
And Aux Money, the hint is in the name, auxiliary, right?
Yes.
Helping other people.
Yes.
The shared economy out here is certainly well and truly alive. But the reality is that you three companies will be natural competitors in this field. How do you navigate that relationship, Raffael?
I think, at least at the very point in time, it's a very local market. Yeah? So we are only in Germany, and we attract German borrowers, we attract German lenders. So Aux Money at the moment is a pure German business. So I don't compete with any of these two at this very point in time, because.
Now, I want to go back to the issue of regulation just briefly, Samir, because you've been very involved in it. I know your stance on regulation is different here, but wouldn't regulation, even though you're advocating it as a stamp of approval, stifle innovation in this industry?
Well, it depends on the type of regulation and how it's managed. So, you know, we took this path because we didn't want to turn up one day and have, you know, the tanks on the lawn trying to shut us down. We wanted to kind of transition into a proportionate regime. And I think the UK government has done a very good job of defining the regulation. We meet with the FCA actually every 2 or 3 weeks to discuss it. And I'm confident that the regulation will be proportionate. You know, if it's done wrong, in the wrong way, it can be stifling. But I'm confident that it won't be in this case.
Okay, so we're nearly out of time here. We've got 21 seconds left. I want to ask each three of you of where you think you'd be in a year's time. Two of you have been back year after year, starting out with you, Renaud.
So I think at this point we're really sort of managing the growth of the platform. Things are going really well. There's a lot of sort of interest from investors, a lot of great customer satisfaction from the borrowers. So we'll keep doing what we're doing, and hopefully be a couple of times larger than we are today.
And 3 times larger next time, right? I'll back you on that one. Sounds like a great investment. Raffael?
Yeah, similar thoughts. It's all about growth now, having the heavy face behind us. So the same. The product works. Aux Money works both for the lenders, for the borrowers. We have seen that over a couple of years now, and now it's really about growing. Yeah, I would hope that in a year we sit here together and confirm the number, 3 times growth.
And Samir, regulated with the stamp of approval?
Yeah, so if you're not sick of the sight of me next year, you know, I'll be back again, and hopefully we'll be 3 times bigger, and we'll be a regulated business then. So, you know, I might have to be wearing a suit and tie and stuff like that. But I think
I have never at LeWeb. Presumably you'd be banned. You wouldn't be allowed through the door all the time in this place. Ladies and gentlemen, thanks ever so much for staying with us for this interesting and lively debate on the issue of disruptive finance. The world of disruptive finance is well and truly alive, and it seems to be trebling every single year. On that note, I'd like to thank our 3 guests here. Renaud Laplanche there from the Lending Club. We also have Raffael Johnen there from auxmoney.com and Samir Desai from the UK's Lending Funding Circle. Thank you very much.